It's the first full week of trading in the month of November, and historically, we're entering the best period for stocks of the year. And that has little to do with a term coined seasonality here. So, this is when we're talking about the stock market, meaning the tendency for stock prices to move in predictable patterns at certain times of the year. Yahoo Finance's Jared Blikre has a breakdown of seasonality.
'Tis the season. We made it through the summer, even Halloween, and now begins the big holiday push. Familiar patterns of buying and selling in the economy, they make it all the way into the stock market to create bullish and bearish fingerprints that we can read. Now we see these patterns align with the calendar, and we can also see them on shorter and longer time horizons, like the 4-year presidential cycle. More on politics in a bit, but first, you've probably heard of that old Wall Street saying, sell in May and go away. Well, we just finished the supposedly worst 6 months of the year, May through October, and here's what Ryan Detrick had to say about it.
When you're up double digits during the sell in May period, so you're strong when you're usually not supposed to be, like we're seeing now. These next 6 months, Josh, get even better, up almost 13% on average and rarely lower.
All right, there's a lot going on, so let's break this down. Way back in 1986, Yale Hirsch, publisher of the Stock Trader's Almanac, divided the year into blocks of 6 straight months and discovered that the worst 6 months of the year were May through October. But even this so-called worst stretch is up 65% of the time with an average gain of 1.7% since 1950. Guess what? Stocks tend to go up. Hirsch also found that the best 6 months tend to be November to April, up an even better 77% of the time with fat average gains of 7%. For several reasons, volatility tends to trend up in October and also September and August, and this is when we tend to see a lot of market crashes, but not so much in November and December. So maybe investors, they just get lulled into the holiday spirit, but the bottom line is right now, we're at the very beginning of this seasonally strong period. And Detrick went a step further. He looked at all the times when in May through October, this period did surprisingly well, up double digits, and in 10 of the 11 times that this happened since 1950, the results were positive, with an average gain of 13%. Now, it might seem like everything is just seasonally bullish right now, and yes, it's definitely that time of year, but it's also a Wall Street truism that strong markets tend to persist. So in a strong bull market, most seasonality studies, they're going to point to more bullishness. Strength begets strength, as they say. And we haven't even discussed the election yet. So the same forces that create recurring patterns year after year in U.S. stocks, they seem to work on a 4-year cycle that aligns with U.S. politics. Now, the first year of a new presidential cycle, it averages nearly 8% going back to 1950. Now, when we get to the midterm year, the second year, this tends to be the worst, up only about half the time, but still averaging gains of 4%. The last midterm year was 2022, and investors probably do not need to be reminded how bad most of that year was for stocks and bonds. Year 3, that's a sweet spot, averaging 17% gains, and in 2023, the S&P 500 was up 24%. So seasonality was working quite well, not only when the market turned south, but also when it recovered. And you're going to notice that year 4, where we are right now, tends to average decent returns, around 7%, and it does tend to finish positive over 80% of the time. But it's where we are right now within year 4 that is turning a lot of investor heads. You can see that right after the election in November is when stocks tend to trend up into the end of the year. And you might also note that September and October, they tend to go south. And while September was unusually strong, October indeed ended red. So if you're not sold on seasonality and stock returns, B of A has run the studies on fundamentals. Election year seasonality is pointing toward a floodgate of corporate investment spending just waiting to be deployed, says a bank. And here's a quote. History suggests that investment activity typically accelerates post-election. We believe the election could be a clearing event for companies to unleash capex, especially with lower rates, said Savita Subramanian and colleagues in a recent note. So no matter how you slice and dice things, it's just tough to conclude that one should short in this environment.